Welcome to the Property Bible. This show was created for current property owners, people looking to purchase property, and for professionals in the industry. Hope you enjoy. Welcome to the second episode of the Property Bible. My name is Kimberly Ackerman. I am a buyer's agent from Trelease Associates in Sydney, New South Wales. Today, we're going to be doing our second episode, and that is on what is depreciation. Now, as a property investor, you enter in a world full of expenses and tax deductions. So today, I really want to explain to people what is depreciation, and as a property investor, how can we take advantage of that? Now, to help me talk about this topic, I want to introduce Tuan Duong, who is a principal and quantity surveyor for Duo Tax here in Sydney. Welcome, Tuan.
Thank you, Kim, so much for having us on the show today at the Property Bible. Very keen to share some insights about what is tax depreciation, especially as a quantity surveyor myself.
Definitely. I mean, you and I have been working together for many years now. You've helped not only my clients, but you've also done depreciation reports for myself and my own investment property. So I think this is a really important topic for people to be aware of. I speak to a lot of different buyers and also even professionals in the industry, and a lot of those people are still confused about what depreciation is. I have buyers that have multiple properties in their portfolio and they still are kind of unsure about it. So I really want to take this episode to go through the ins and outs, really basic understanding of depreciation, and then talk a little bit more about how people can take advantage of that while they have investment properties. I guess just to get into the more high-level question, what is depreciation? So if you could give a bit of a basic understanding for the listeners out there, that'd be fantastic.
For sure. I guess to give you a basic definition of what depreciation is, it's essentially the wear and tear of a typical asset. Now, wear and tear means that if the ATO recognizes that when you buy an investment property, you're buying assets, right, including the building and also the plant and equipment within the building. Yep. Now, things like the air conditioners, your carpets, your anything to do that's motorized, it might be ovens, range hood, hot water systems, they're depreciable assets as well. And the idea is that when you buy this investment property, it's almost like a vehicle to drive your business, and essentially you're entitled to claim depreciation on these type of assets. So working out the wear and tear on each financial year is what our job is. So each year there will be some depreciation on these assets, and what we're trying to do is assess what that dollar value is, so that way the property investor can claim that dollar value on each of those type of assets pulled together, and then work out a tax deduction amount so that they can reduce their taxable income each financial year.
Okay. So from what I understand, just for clarity purposes for people listening, your investment property that you're buying is sort of like your company or your business, so to say. It's a facility that allows us to make an income of some sort. Now, what the government does with tax depreciation, and correct me if I'm getting the clarification wrong here, but they sort of say, okay, you guys have this investment property now. There are elements within that investment property, perhaps fixed items, even things such as paint on the walls itself. Those items are going to wear and tear over time, and the government basically wants to give us money back on that item that is depreciating in value over time.
That's right. The correct terminology that ATO uses is income producing asset. Correct. So these type of assets, like this dishwasher, oven, range hood, they're income producing assets because the investor has rented out this property to a tenant, and essentially the tenant is using that property for their benefit and paying rent for it. So essentially it is an income producing asset, and hence as it depreciates, you are entitled to claim it. And of course, when you live in these properties, if you live in a property you've bought, you can't claim it because it's not an income producing asset.
Investment.
Exactly.
Okay.
Right.
And we want to take advantage of the maximum amount of depreciation when we buy an investment property. So really, that's having someone like yourself as a quantity surveyor coming through the property, making a list of everything that's depreciable and writing a depreciation report or a depreciation schedule for somebody. So the next thing I really want to talk about with you, Tuan, is the misconceptions of depreciation. So those people who have a very basic understanding of depreciation and they do have depreciation reports in place, or they're thinking about getting depreciation reports in place, some of the big misconceptions I'm finding are things like, do I need all the receipts and invoices for all the work that I've conducted on this property? And from what I understand, the answer is no.
It's a very good question because as you buy an investment property, you're obviously going to do work to the property to improve the property, and improving the property ultimately generates more rental income. Now, when you do that, there are some circumstances where invoices go missing, jobs may be done in cash payments, things like that do happen from time to time that we see from clients. And I guess the very important thing is that people, there's a misconception that they can't claim anything. The most important thing to do is get a quantity surveyor to actually assess the property or the building for those renovations or improvements. We can assess it for what it is and do some comparative reviews based on the previous work and what's there now. And if we can do that and actually justify the amount of cost that's going into it, that allows us to claim some depreciation on those new components, even though there's no receipts or any documentation backing that up.
Yep. So don't need receipts or invoices of any kind. You guys are going to come in and do your own assessment regardless, based on fair market value, from what I understand.
That's exactly right.
The second real big misconception I'm finding when I talk to investors and buyers in the current market is that they haven't done renovation, so therefore they don't need a depreciation report. That's a really big one. And I always say to people, get a quantity surveyor to run the numbers for you. It's free to do so. You can find out in advance without paying any money if you're going to get money back, and literally have the report pay for itself. So for those people who have bought a property and not done renovations, there's two aspects of that. Can they claim on any renovations done by the previous owner before they own that property? And the second thing is, if there haven't been any renovations done, should they be getting a depreciation report anyway?
Yeah, great question. And another great misconception is that it's probably the biggest one.
Yeah.
Most of our clients buy secondhand properties. That's just a given.
Yes.
And when you buy a secondhand property, people assume that you cannot claim depreciation because it's like old. But generally, the ATO does have some guidelines to claim on secondhand properties. Anything built after the 17th of September 1987 can claim depreciation. So there's at least almost 30 years there of depreciation that can claim for a property that's 30 years old, which is a great, benefit, advantage for any secondhand property investor.
Yeah.
On top of that, when you buy a secondhand property that's built after 87, you can also claim, or even it's built before 87, you can actually claim on the depreciation on the renovations. Now, renovations have to be completed after the 27th of February 1992.
Okay.
So if you've renovated a property after Feb 1992, you can claim depreciation on it, and not just the original owner, but also every consecutive owners. So if a renovation was done in 1992 and you buy a property in today, you've got until 2032 to claim the depreciation that was renovated back then.
Yeah, wow.
So there's huge advantages there.
There's so much lost money.
It is.
From people that are not claiming it at tax time. And I do want to talk about when they get a depreciation report and how people claim this sort of depreciation through their investment properties. But that's a really good point to sort of touch on, because a lot of my clients say, I don't need one. I haven't done any renovations. And I say to them, just get a QS to come out and do an assessment, because you'd be very surprised at the amount of money that you can take advantage of. And the report pays for itself. It's sort of like a no-brainer for me. I'm so weirdly passionate about this topic. And as a QS, I'm one of your biggest fans, because I'm like, people just don't know that they can take advantage of this. And if it pays for itself, it's, why not do it?
Certainly.
But look, there's a case study I really wanted to talk about today, and that's for a client of mine that you and I were working together with. This client of mine has an investment portfolio already of 4 properties in Australia. Now, she wasn't ready to, we're looking at purchasing a new property for her for that portfolio, but she wasn't ready to sell off or do anything like that for the current investment properties that she has. So I said to her, why don't we review them? One of those elements of reviewing the current properties is, do you have a depreciation report? Now, as a buyer's agent, I've very much got to stay in my lane. I'm not a financial advisor. I'm not a builder. I'm not all these other things. So I wanted to make sure that it was mentioned to her. However, it's not really my job to make sure that that gets undertaken. It should really be the accountant, from what I understand. Now, at the time when I mentioned it, it had never been mentioned to her prior. She has 4 investment properties that she's had for many years now. And with no depreciation report on those investment properties, I dread to think the amount of money that she has lost out on because she didn't have those reports in place. So I engaged with you and her to get together, discuss those properties. Now, within one phone call, less than an hour, she had literally been granted with 15 grand worth of depreciation. And you were able to backdate those reports 2 years as well. So those 4 properties that she now is about to have depreciation reports on, she was able to gain a lot more money back, especially around tax time. And I think that's a good case study to consider, because not having those reports in place is really detrimental as an investor in your property portfolio.
For sure. Have to agree with you there. And the said client, there are so many of an abundance of clients out there that we've got that are in very similar situations, and they go beyond 4 properties. I'm talking 8, 10, 12, and they've never had a property depreciation schedule done. And they've had it for 10, 20 years, these properties. So it's a really unfortunate thing. Now, with the ATO, yes, you're correct. You can amend up to 2 years from the date of notice of assessment. So once you receive your notice of assessment for the year that you held the properties in and purchase those properties, you're entitled to amend that tax return. So right now in 2020, we can go back to 2018's tax return, amend that and claim the depreciation there, reduce the taxable income and get a refund out of that if possible. And we can do that for a couple of years. And if you want to, you can actually go back 4 years.
You can go back.
You can go back 4 years for businesses if you're buying a property in a business, which is unlikely. But if you wanted to, you can also extend and go further back, like some of our clients we've seen, and we go further back than that. And that's to raise an objection with the ATO. And we've seen clients go back 10 to 15 years.
Yeah, wow.
But of course, it's at the discretion of the ATO to allow the claim.
Yeah.
But 2 years is a certainty when it comes to amendments.
And it's not 2 years because of your report. It's 2 years because of the amount of time you can go back in accordance with your tax return in the ATO.
That's right.
From what I understand. And look, before we wrap up this segment, I guess I want to give people some tips of the things that they need to consider when getting a depreciation report and hiring a quantity surveyor such as yourself. So I guess from a qualifications or licensing registration perspective, what are the types of things that people need to check when they're looking for QSs?
So quantity surveyors essentially have to be registered tax agents, but before being a registered tax agent, you do need to be a registered quantity surveyor. So there's an Australian Institute of Quantity Surveyors that registers QSs like myself and our business, and that's Duo Tax Quantity Surveyors. And that allows us to be quantity surveyors, but to provide the advice of depreciation, we do have to be registered tax agents. So that's one thing to check.
Okay.
Registered tax agents not being ones to prepare tax returns.
Yes.
We don't want to do that. We just want to specialize in preparing tax depreciation schedules, and that's working out the dollars and cents of your investment property's construction costs. And that's essentially what our job is. And they're the type of qualifications that you want to check for prior to doing that. And within our business, we only specialize in depreciation. We don't sort of diversify what we do. Me, myself, like you, Kim, was a property investor before I became a professional. And that's very important for me because, helping people get ahead with investing in property through depreciation was my sort of end game and my goal in life. And so, I think there's huge benefit in what we do. And hopefully people can, especially the audience, can jump in on that.
And that's the thing. I mean, we're paying for these reports, which are anywhere from, I'd say, $400 to $600 or $400 to $700 on average, depending on the QS. So I think it's a really easy process to go through. I think that, if people are considering this, the first thing that they should do is just really explore the option of using a QS. It doesn't cost anything to give you guys a call and find out if your property qualifies. You can do that through online research and so forth. Once the property qualifies, you arrange an inspection. Report takes 1 to 2 weeks to be undertaken. given to the accountant, and the accountant basically keeps it there for up to 40 years unless there's any further renovations done during that time.
Right.
And every tax time, the accountant brings it back out again and looks at the figure to be depreciable for that year, looks at the figure for the next year, looks at the figure for the year after. So it's a really simple process that I think people can go through. So Tuan, really just to wrap up what we've talked about today, and to give people some tips on what to do moving forward. If you're looking for a QS, make sure they're appropriately qualified and they're registered in the various areas. Obviously, make sure that their property qualifies before going through that process, which the QS will do anyway. Definitely make sure once they do have that report, it's handed over to their accountant for use towards their next tax return. I think a couple of things to keep in mind are the fact that the reports will last up to 40 years unless there's any renovations done. But
Correct.
also for off the plan properties, the developer or the builder should be handing over a depreciation report when you purchase an off the plan property. It's not something you have to do
It's
separately.
always worthwhile asking.
Absolutely. So I guess the last thing to really take advantage of is if you do obtain a depreciation report, make sure that you're checking with your accountant that that report is backdated. If you've had that property for 2 years or more, try and get that report backdated. Keep in mind that you can backdate more than 2 years. You just have to go through an objection form and an objection process through the ATO, from what I understand.
Is at their discretion.
At their discretion, exactly. But yeah, I mean, hopefully today has been helpful. I learn stuff from you all the time. So even having this conversation today, I'm learning things about depreciation that I can use for my portfolio.
And the beautiful thing with it is that the tax depreciation schedule is fully tax deductible.
That's
including
also
the
tax
GST.
deductible.
Yeah.
So you're getting tax deductions from all areas here.
Correct.
It's a no-brainer, in my opinion. Anyone that has investment properties, check if you have depreciation reports. And if you don't, make sure you go and get one or organize one through your accountant and take advantage of this tax deduction, because you could be missing out on thousands of dollars sitting there each year for your tax return.
I think you've covered just about everything on tax depreciation.
Yeah, I think we have. So thank you so much for coming in today. You're always an amazing help for myself and my clients. Appreciate you being here today. And I mean, that's really a wrap for today at the Property Bible. Join us soon for the next episodes coming up. We're going to be talking a lot about valuating property, and also a big one on property insurances. So hope to see you next time. Bye.